Okay, folks, welcome to Volume 8 in the Inner Circle Traders Market Maker Collection. This is Volume 8 of a 12-volume series, and this specific volume we're going to be dealing with the importance of time and price as it relates to your trading in the foreign exchange market. Now, what is so important about time and price, and what are we going to be dealing with specifically as a teaching for this particular model? We're going to be looking at how do we use higher time frame charts to trade with the market makers. Like, what is it you're specifically looking at the higher time frame charts to derive a specific insight from? What is it that you're supposed to be doing? We're going into details about that, and we're going to be revisiting the range expansion and range contraction concepts that I'm familiar with in many of my older teaching tutorials. And we're going to be looking at price equilibrium and price disparity theory. We're going to be looking at institutional pricing as support and resistance. We're going to be, in a certain sense, revisiting the Power 3, which is my ICT accumulation to distribution concept. And when are stop rates likely and how to anticipate them. How to visually see institutional accumulation and distribution in price. And what does institutional order flow look like in price action? And how market makers reinstitute and reclaim previous order blocks. And we're going to discuss why pattern trading is not pattern hunting. And we're going to be looking at time and price in conjunction with news and market data releases. So let's take a look at the first in this list of specific concepts and ideas and theories. Glean what it is specifically you should be looking for in your higher time frame charts. Okay, folks, we're looking at the British pound, USD, otherwise known as the cable in the FX market. Now, when we look at the higher time frame charts, we obviously start at a monthly, work our way down to a weekly, then to a daily, then to a 4-hour. And then below 4-hour, we only concern ourselves with the 60-minute, 15-minute, and 5-minute. Now, prior to going below a 4-hour chart, it's imperative that you understand where you're at in the higher time frame, because contrary to what you might believe, okay, and what's being led to have neophytes believe on the internet, and many courses and authors focus on having a 1-minute perspective or a 5-minute perspective because they're so ingrained with a thought process that the intraday charts are closer to the market. No, I'm going to dispel that whole idea right here. Is there a benefit or a use of using those lower time frame charts when you have a perspective that's based on a higher time frame? Certainly, yes. But by far and large, you're going to learn, and you probably can admit if you were in a classroom setting with me, you would all probably be raising your hands now. You were all indoctrinated into the technical analysis world with foreign exchange with lower time frame charts like 1 and 5-minute charts, or even tick charts. Well, that's really not getting you closer to the market. Okay, I'm actually going to turn the tables and actually show you how you really get closer to the market. Okay, because the market is defined by the deep pocket institutional bank traders. Okay, they are the market. We are just fleas on the back of that dog. Now, sometimes they'll scratch and kill us, and then other times we're lucky enough to ride along on their coattails and you get to wherever they're trying to get the market to go to. But it's important you understand that in this whole series, I'm trying to pull back the veil, if you will, for all of the retail traders to get a institutional perspective that is not really taught, as it relates to using price action. By far and large, you're going to find, if you look at all the things that are available, everything is based on a retail perspective. Indicators mathematically derived on what's happened in the past on the left side of your chart, type thing. And just because you're looking left doesn't always give you clues to the future. Okay, not just simply looking at retail indicators. Okay, that's not going to do anything for you. And just looking at old highs and old lows isn't enough either. You got to look inside what price action is depicting, okay, to suggest what it may do on the right side, the hard right side of your chart. Okay, so it's it's very easy for new traders to, to latch on to someone as a mentor or a teacher or read a book or such and see examples of things that worked in the past. And we all understand, if you've opened up a demo account, if you opened up a live account, if you read any, structured teaching about trading, the first thing, if they're responsible as a teacher or an author, they're going to tell you past performance is not indicative of future results. And that's true. And that is not any exception to my rule of trading either. My things aren't always 100%. In fact, what you're going to find is many times when it fails, it's because we, the trader, misinterpreted it. Okay, so there's always a human fallible component to everything, and trading with my tools are no exception. Okay, so keep that in mind. But over time, okay, and remember, I've been doing this for over 20 years now. It takes a lot of time to get to the level of appreciation and trust in these things. So if you're just now starting to warm up to my material, okay, this again, give yourself some time and permission to develop into the trader that you'll be able to utilize this stuff in time, consistently, have faith in it and trust in it. But now, what is it specifically that we're going to be doing with all the things, if you've always learned in all my teachings and my review videos? How am I arriving at all these things? What tools do we mesh together on a higher time frame, and for what purpose? What is it supposed to give us? Are we to derive a bias, or how do we trade without that bias on a higher time frame? And we're going to get into that now. Now, looking at the monthly chart, now obviously this is going to have the benefit of hindsight in some respects, okay, but you're going to be able to see this is how it's done going forward, and you'll see everything with a different perspective after having this installment in this particular video series. When you look at the higher time frames, starting with the monthly chart, you're going to be looking at areas of old highs and lows where they had significant reactions. Okay, and by that I mean, like, obviously you see a low here, it reacted very strongly there. We have a low here, price reacted very strongly there. We have a low here, price reacted strongly, and another low here, rather significant reaction in price. We had a high here, okay, price came down, and we had a high in here. We had a high in here, price reacted very handsomely. We had a low, a high, we had a low in here, we had a high in here, rather significant high in here, and we're right now below these lows in here. And if you've been following my commentary on Twitter and or my review videos and live webinars, I've been telling everyone for months that we were going to go below these equal lows and trade into this low, and maybe even go a little bit lower. And that has since come to pass. We have a low back here as well, and this high, a low in here, and we have a low in here, and a low here. Now, obviously, you're probably saying, okay, well, this is pretty obvious, Michael. You're starting to bore me. Okay, well, that's good. You want to be bored. Okay, trading should be boring for you. It should be a monotonous, redundant process that goes on and on and on, but yet profitable. Okay, so now what we look for is areas of range contraction and areas where soon after there was range expansion. Okay, now what do I mean by that? Well, we had an area in here where we moved from big ranges, the large range moves lower. Okay, now again, mind you, this is a monthly chart, so these ranges are depicting the high and low, open and close of that particular month. So that's a lot of price action inside of these candles. The the market moved in large ranges down, and then started to have contractions. They were going into smaller ranges, smaller ranges, smaller ranges. And then what happens after small ranges? Large ranges. Okay, this is one of the concepts and cycles that I learned from my mentor, Larry Williams, and it's a rather generic cycle in the marketplace, but it really goes unnoticed. And if you look at what you did when you first started trading and you put yourself in front of a demo account, whenever the market started ripping higher and started taking off, moving aggressively higher, what did you feel compelled to do? In all honesty, if you're going to be honest, you're going to say you felt this insatiable desire to want to click the buy button. Okay, you wanted to chase price. Well, that's what retail traders do. They chase price. After it starts moving, they want to chase it. A institutional or smart money minded trader, which is what you're aspiring to be and what I'm trying to teach you to become, you're going to evolve from that perspective, okay, into the opposite. You want to be looking to be a seller of a position you hopefully have already obtained a long on when markets are running up, okay? And you want to be looking to be a buyer when markets go lower. Okay, it takes a little bit of a paradigm shift where you're buying in the depressed market where it's dropping. It doesn't feel good to be buying. It feels like it's going to continue lower. That's where retail traders lack the perspective that's needed to overcome, number one, quickly the dealer spread. We all have to overcome that. I'm not outside the scope of that. I mean, all my trades enter the market with a deficit. I have a spread that I got to overcome just as well as you do. If you trade when the market is moving lower and you're buying in that instance, okay, you will quickly overcome that dealer spread in just about no time, really, many times, instantly, many times if you do it right. But contrast that with when you were trying to chase price, okay, if you're buying in that, you may sit through some intraday or intra-month, in this case, retracements that may have even stopped you out, or worst case scenario, didn't really come to your stop, but it scared you and you collapsed the trade before it actually seeing the trade come to fruition. Why would you have done that? Because you chased price and it didn't see the rather you didn't see the continuation of the move higher that you were anticipating, because you've already seen it move 20, 30, 40, 50, 80, maybe in 100 pips, and then figured, well, it's been going up, so it's going to continue going up, and then you obviously will have a retracement of some sort. Well, what we like to do is we want to see price move from an area of contraction, okay, with a spirit of anticipation of range expansion, okay. We also want to be looking at areas where we had clear, discernible order blocks, okay. Now, the larger magnitude of the move from a particular low, okay, or high, is going to be important. Okay, it's going to be significant to you in terms of what type of trade you're going to view this as. Just because you're on a higher time frame chart doesn't necessarily mean it's going to be a long-term trade. Okay, it could be a one shot one kill setup where you're just doing a short-term trade, or a weekly setup where you're trading, for a couple days, from maybe a Tuesday to a Friday hold, or maybe a swing trade where you're holding it for a couple weeks. it it's going to hinge upon your understanding of market structure as it relates to long-term low, intermediate term low, short-term low, and where we're at in the scope of that overall market structure, and where are we at in terms of a buy or sell model, and are we in a buy or sell program. Now, if you're familiar with my previous teachings, I'm not going to reiterate all those things here. Okay, a buy and sell model is not the same thing as a buy and sell program. Okay, buy and sell program. I'll just tell you this. Go back to my previous courses and teachings, where we use the moving averages, 18 and 40, and 9 and 18. When they're stacking up, you're in a buy program, and when they're stacking lower, you're in a sell program. Okay, the buy model is contingent upon you understanding the market maker buy or sell model. Okay, so you're going to blend those two to get a bias, and we're not teaching bias here. We'll go over that in greater detail as it relates to specific trading styles in the later modules in this series, but for now we're just going to look at what you're specifically looking for on the higher time frames to begin to flesh out trading ideas. Okay, it does not depend upon a trading bias. Okay, and I'm going to show you that here with the higher time frame. We have a large reaction in here. Okay, and what we're going to do is we're going to put a horizontal line on the top of this bearish candle, because it's the down candle prior to the move up. We have that nice reaction in here. Okay, and then price comes back down. So we had range expansion, goes down, retraces, and goes into contraction. You see that with smaller ranges. What do we anticipate after that? Range expansion. Price sees a move higher, the ranges start getting larger. Okay, the public starts to chase it. what's it going to do invariably? It's going to retrace and move back to a previous area of buying. Here's the down candle prior to this move up. Price comes right back down into that area of this down candle or bullish order block. Okay, we get into smaller ranges again. What's going to happen after the smaller ranges? Range expansion. Okay, another move higher. As we see this cycle of range contraction and range expansion, okay, you're going to see that and dovetail that with your order blocks. Okay, when you see a bullish scenario and the market starts to retrace back into it, you want to anticipate the range to start to get smaller and tighter. Why is it doing that? Because they're slowly buying into the position again. Okay, they don't want to add real big positions all at one time because it'll cause the market to take off, and then it'll cause thin gaps, and that's not conducive for smart money to build large positions. So they have to do the buying as it drops, yes, but when it gets around that particular level that they want to average in at, they will do smaller little portions. They'll break their buying up into smaller blocks, so that way the market can digest it a little bit better and still stay close to what would be deemed at the time a fair market value. That way there's no disparities created, and it stays within an area of price equilibrium. Okay, so overall, if you look at the overall range in here, we have the high of this candle here and the low of this candle, and I'll give you an idea what I'm referring to here. If we look at that in the sense that this is a trading range here, okay, um, between the high and the low, if you look at the 50% level of those two price points, and let's just bring it over here so it's a little bit easier to see right in here. 50% is right in here, so this is what would be deemed fair value or equilibrium between the high and the low. So the low here and the high. So equilibrium is right in here. And if you look at the overall price in here, there's a lot of times where price had traded at that level, but when it moves away from it, it's kind of like if you had a rubber band, if you will, and it was anchored to this particular price point, and if you stretched it lower, okay, it's only going to go so far, and then finally it's going to snap and go the other way and go to an extreme on the upper end of the 50% or fair value. Okay, and then what will happen is it'll come back down again and stretch below that equilibrium or halfway point of the total overall trading range. Okay, and what it's doing is every time it stretches away from what would be deemed equilibrium or fair value, it's creating a price disparity. In other words, it's not, this is not going to be deemed um, uh, a fair value. It's going to be viewed as a discount. Okay, and this right here would be creating a premium in that price. Not premium in the sense that we talk about commodities, so don't get that confused. In other words, you're going to be buying inflated pricing here. You don't want to do that. You want to buy very cheap discount prices. So if you understand equilibrium, okay, and equilibrium is finding overall trading ranges in consolidation, okay, and when we see consolidations and we identify trading ranges, we like to see where are we at in terms of the overall trading range. Are we below the 50% level? Because if we are, we're below what we deemed fair value or equilibrium. And it's going to create a disparity in price. It's going to be viewed as undervalued or discount. So what will happen is buyers will come into the marketplace on an institutional level, and depending upon where you're at in the overall market structure, it will give you the basis for a longer term trend, higher or lower, based on that understanding. And again, I'm speaking conceptually now, and we're going to build on it as we go through this video and the latter three in this series. But for now, again, I want you to understand that this is a bearish candle prior to this move higher. That's a bullish order block, as we identified in previous teachings, and we've reiterated in this particular series as well. But this level, okay, this is just one. Then we have an area of consolidation in here as well. Okay, price moved from big ranges down into smaller ranges again. Okay, and then price moved away from it and started moving into larger ranges. What we're going to look for again is the bearish candles prior to the moves that take place moving higher. We have a down candle here. So we're going to create another notation with a horizontal line on that. And this little candle in here, it's a small candle, which is good because what did we talk about just a moment ago? Small ranges beget large ranges. Okay, while the market's real quiet and you seesawing back and forth in small little ranges, no one's really interested. Retail traders aren't excited. They'll say, well, we're in the doldrums. Oh, it's choppy, or it's not going anywhere. And what are they going to do? They're going to look for another pair or another market asset class to be putting their money in because it's exciting somewhere else. Smart money is going to be interested in the markets that are quiet. Okay, it's just like when you're trading options, and we're going to talk about that later on in this overall uh, teaching, because I'm going to be talking about options trading in stocks and commodities. But you want to understand implied volatility. When implied volatility drops below historical volatility, that means the market has become quiet. And when those periods of quietness come upon, price action really just heats up and you get this injection of volatility, and boom, you get these big moves. Well, the same thing happens when you just look at the ranges on the market that you're trading. If the ranges are big, don't chase it. Just wait for it to go into a retracement or move into a level of higher time frame order block, and then look for a pattern later on based on that understanding. But using the ranges between large ranges and small ranges, you want to look when the market's trading small little ranges. That's when you anticipate these next big moves. Okay, we're not interested in chasing price, we're anticipating price. It's a big paradigm shift from what retail perspective traders are doing and what we're doing. Okay, we are not gambling, we are not throwing dice. Okay, we're looking where the highest probabilities are in our favor of seeing a dynamic price move. Okay, so now we have a down candle here. Okay, this down candle is already identified, but we have this one as well. The body of that candle is basically encapsulated with this line as well, so we're going to keep that exactly where it's at. Now I'm going to ask you a question. Do you see anything about this particular level that may be of any importance? Look closely. Look at the lows of these candles back here. Look at the high of this candle. Look at the bodies of this candle here. All these three candles in here. This candle here, the body of this candle, the body of this candle, and the body of this candle, and the body of this candle. You see how that's all really close to that same overall price level? What is that suggesting? This is suggesting that this in here is what would be deemed an institutional price level, okay, for trade. Okay, not an institutional price level like the 80s, 20s, 50s, and evens like we talk about. But what I'm saying is this is a good level to anticipate actual trade entries at, because there's a lot of activity around that particular price level. And you can see that they were in fact interested there because it took off and then never came back for a long period of time, many years actually. Moving on into present time of this recording, you can see the price had just recently come down to these areas, okay, as well. But when we get around these levels, just on the higher time frame, they have to be refined on the lower time frame, and then we're going to do that in this example here. But um, the next idea I want to bring your attention to is when you're looking at higher time frame charts, you also want to look at the overall market structure, not just the order blocks or old highs and old lows. You want to be looking at the overall price structure. Okay, if you look at what we have here, we have the market moving up from a low to a high, and then we have another market swing from here to here, okay, which is comparable to this move here. We have this low to this high. Okay, so we have a dominant price swing here, a retracement, and then another rally up. But this price swing here is the second leg of what this leg is already done inside of this initial parent price swing. So if you look at what we have an equal distant measured move type thing, an ABCD extension is commonly referred to in price action or technical analysis, if you will. This low here is significant. Why is it significant? Because it's one of a multi-leg price structure. So now Knowing that, combine what we've just discussed. We have a market that moved from big ranges down into smaller ranges, and we moved into consolidation. What what is going to happen, or what we would rather expect to see at that time? Okay, and again, I got to speak in a certain measure of hindsight here to be able to teach the concept, because what I'm going to show you in a moment, it's going to be a lot more significant to you. But for now, understanding that just because we're looking at old lows isn't enough. You want to look at the market structure as well, because what I'm saying to you here is there was a lot of buying here, there was a lot of buying here, but there was a lot of buying here as well. Okay, so there was a lot of order flow entries right in here in the long side. Why? How do we know that? Well, because it obviously took off. But why would we expect that? Well, if you go through the candle here, cut right on through that, you'll get to these highs over here. Continue going over to the left again. Cut through these candles. What do you see? A lot of buying here as well. See that move here? See, there's this idea that supply and demand is what I teach, and it's not what I teach. Okay, I teach institutional order flow. I teach how the banks view charts, how they look at areas of previous fair value and price disparity, and where they look to do their buying and selling. Okay, is important, not how supply and demand traders look at price. Okay, I don't care about rules that were created by a ticket runner not to cut through candles. Okay, I worked and rubbed elbows with bank traders, and I'm telling you, we don't care about cutting through candles, because you're not going to see institutional buying if you just stop at a present range and never look beyond it. Look at what I'm suggesting to you here. You're going to cut through this area here is of importance. Why is it important? Because if you cut through this candle here, go all the way over here, this level here is now significant again. And cut through this candle here, this area is significant again as well. Now, if we take the body of the candle right here, just the body, we're not looking at the long wick, okay? I just want to focus on the body of the candle here. You nail it here, and you're in it here as well. But more importantly, prior to this big move, look what the body of the candle is on the down candle prior to the big move is. It's inside that area. Supply and demand does not give you that precision. ICT does. Okay. Now, I'm not patting myself on the back. I'm just telling you, you are light years beyond what everyone else is teaching and learning from everyone else, okay, out there on the internet and all these other supposed seminars and teaching, circuits. They're not aware of this stuff, okay? Um, you are going to be limiting yourself if you do not cut through candles. Okay, you got to go through it. You got to go through and look at overall price structure and blend it with institutional order flow. Who were the participants that caused this market to move up? Is it supply and demand traders? No. Is it support resistance traders? No. Is it retail traders? No. Absolutely not. It's not baby pips. Okay, it's not FX Street people. It's not Forex Factory Forum guys. It's none of those people. Okay, it's banks, institutions, large firms. They are the ones that create these large extrapolated price moves. Okay, so when you're looking at price, you have to identify when markets are moving significant. Okay, those are footprints that large buyers or sellers are interested in those levels, because in those levels, okay, we're in areas that they're going to be doing future trading again, okay, and they're going to be influential to you as a price action trader, both on buying and selling. And how we measure that and lay that out with market structure, and we're going to talk about that in this video. It's going to be paramount to you being successful using these concepts. Now, do you need these concepts to be profitable? Absolutely not. But you will not find anything else this precise that gives you the foresight to know when to anticipate it, how to anticipate it, and have the, well, everyone asks me all the time, the bias, if you will. Okay, this is how I arrive at it. Okay, so now When we see these areas, okay, all they do is draw the attention to where there's large institutional order flow. But they have to, much like everything else I teach, they have to be further refined. So now we have an area in here. We have this down candle right here. Okay, that down candle prior to the move up here, it retraces back into it right there. Okay, and then boom, it takes off. If we take this idea, in much in the same vein that we cut through going to the left to find historical support and resistance theory in the order blocks and market structure, okay, this concept can be projected through candles like we see here. And if you look at what we have, we're going to just take um, the range and just extend it out in time, and you're going to see all of a sudden this reaction that no one else saw. But we talked about this level here. Okay, if you look at my old videos, we talked about the likelihood of the 172, the 171.80 level. Okay, that would be a significant area to expect some selling pressure. Okay, and in fact, when price was rallying up here, we were talking about the false breakout idea above this high here and this high here, moving up into this old low. Now, traditional support resistance traders would expect you to believe that it's going to work like this. Okay, and you're going to see a glaring disparity between what we teach and what actually happens. A low here on this candle comes in at, let's get it on there, the low comes in at 170.46. The actual high that it moved to was 171.92. That's a pretty significant difference. Now, not so much if you're a higher time frame trader and you use multiple hundred level uh, stops. In other words, if your stops several hundred pips, which I don't trade that way, but I mean, there's traders that can trade that way and feel comfortable doing it. This probably wouldn't be a big deal to you, but because I'm an intraday timing type trader, I like to use a 15-minute and 5-minute entry on something I've arrived at on a higher time frame. That's a big disparity between 170.44 and the 171. What is it? What do we have here? Get back to it again. 171.92. I mean, that's a significant difference in terms of overall risk exposure, and in deference to the pips that's necessary for your stop. But what I'm drawing your idea of looking at price in a way that it will give you the understanding that's necessary to flesh out areas of anticipation when we anticipate price. Well, when we're looking at higher time frame price charts, and say prior to this move up into this high here, as price was rallying up, we were bullish all through this. If you go back and look at all of my YouTube videos, we were calling higher prices in the cable, higher prices in the euro, lower prices in the dollar. And if you go on my website, you'll see links for market reviews that were discussing all this as well. The the idea was you look at old highs, okay, for price to reach to them. And until we reach them, you maintain a bullish stance. Now think about what I just told you. Okay, write this down in your notebook in big bold letters and then highlight it and circle it and underline it. Okay, when you're looking for an idea to trade on, when you're looking at higher time frame charts, where we are at now, presently, you ask yourself, where is price reaching for? What price level is it reaching for? Where is the next level of institutional interest? Okay, prior to this move higher here, there would have been an interest above these highs here in the form of buy stops. There's a lot of traders that believe that if they break this high here, it's probably going to continue all the way up, maybe even trade back here. Now, obviously, we saw that wasn't the case, but there's a lot of people that believe that in the market. And there would be traditional support resistance traders would say this would be a good area to anticipate price reaching to, and that would in that camp they would be correct. Okay, but when you understand institutional order flow, let me ask you this: does this high and this high have any institutional um, significance other than the fact that there would be buy stops above it in here as well? No, because all we have here is a big range. We have this really big range in here. Okay, so you got to cut through that range and find out what the previous institutional structure right here. Boom. You got to go through candles to find out where price is most likely heading. Now, let me ask you a question. The buyers that would have had positions here and were long here, okay, when the market traded through that, did it ever get to that same level again once it broke through? This is the closest it got. And then we had to go through 4 years to get back to that same price level right there. Now, let me ask you a question. What retail entity would hold a position that long losing? I would argue none. Most of you can't even stand an hour, under the water in a position before you start going crazy. But I'm going to remind you about something that, again, the retail universe cannot grasp this concept. But banks can hold net loss positions a lot longer than you would have yourself believe. Because they are the market, okay, they are willing to allow themselves to sit with a deficit on their books because they have other transactional costs that they charge their customers that help offset the what would be deemed as a net loss or losing position on an open position, if you will. They're able to um, kind of like diversify their income to offset, not entirely, but offset some of the um, the adverse problems of holding that loss on their books. They will, when price gets back to these levels here, they will then unwind what would be at the time here. Okay, once it's taken out that low, now they're in a net loss, a rather significant net loss position. Okay, you're looking at a very steep decline. Okay, and this is exactly when we had the banking um, fallout. We had all that issue with the banks potentially failing, and we had to do the bailout. Everyone knows about that. But now they had an opportunity to now mitigate that. So everything they were sitting in with any positions that were net long still from this point on and holding on to it. Okay, they had to sit through all this, and then technically they came out of it right here, and that's what you're seeing. Okay. Now on the lower end, okay, because we just described how we cut through all candles to get to an area of understanding of where institutional interest is on higher time frames and how we look for price action to move to different levels. When price started to fall from here, the question is going to be is where would there be an interest of seeing price get to? We have a down candle here. So as price was dropping, this was a significant level to be monitoring. Okay, if you look at the bodies of the candle, there was a significant interest. If you go down to a lower time frame, you can clearly see, and I'll let you do this on your own study. You could have been taking trades on both sides of the market, I'm certain, around that same level. Now, did it continue on lower? Yes, it did. Okay, what will be the next level of interest? The down candle prior to the move up. Okay, it's going to reach into that. Okay, we got down through it around the holidays. Okay, and then below it would be these equal lows because we understand that there would be sell stops below these lows, and there would be a liquidity void down there, and price would reach for it. Okay, price coming down into a level that if you cut through candles now, we're going to cut through this bunch of candles, we're going to cut through this bunch of candles to arrive at the same order block we had back here. It's the beginning of this move here. Now we're back in an area of price sensitivity again. Okay, so we can anticipate an area of buying pressure to come into the marketplace again. So we're looking at higher time frame charts with an idea that where are institutional traders most likely interested in trading based on what's already happened in the past and previous footprints that they've left. Because if they were interested in buying it back here, okay, that's a significant price level if we get back to it again, especially if you understand what it means in the whole grand scheme of things. If this position was a buy and it went through it here, they're going to want to get out of that there when it gets back to it to mitigate that. So this is a bullish order block that becomes a buying opportunity here for a buy setup, but it becomes a mitigation block later on in time. And yes, you're cutting through candles to arrive at that understanding. Okay. So again, it's not supply and demand, guys. It's institutional order flow. Now, looking at what we have here, if we take ourselves down one period and we go to a weekly chart, and let me click the weekly chart tab, not the monthly again. Okay. We're going to zoom out again, and let's get this off because I don't need it. We have this trading range defined here. Okay. But look, we have this reaction as well. See this reaction? We're going to zoom in on this little area here, right in here. Okay. We have big ranges, and then what happens? We go into small ranges. What's the small range going to create? Big ranges. Okay. And then we have down candle, range expansion again, retracement, small ranges, big ranges, retracement, big ranges, small ranges. Then what's going to happen? Big ranges. Okay. What you're looking for, again, is areas of liquidity. Okay, in other words, above old highs and below old lows. And you're looking for previous areas of institutional buying and selling. Okay, and from areas of consolidation. So if we can see areas of buying interest, like we see here, okay, what I like to do, and this is one of the concepts you've probably seen in my, I'll move that when it needs to be moved correctly in a moment. In my old videos, I would look at an area here and I would highlight it with a square or a block on MT4, and I would use it as a marker. And then we would zoom into that little area and then refine down to really precise order blocks that we can trade on. That is certainly what you can do, and I'm not trying to discourage that, but I'm trying to give you a higher level perspective on what you should be doing with higher time frame price charts. And what we do is when we see price action like this, we have the down candle. Now, yes, there's a big, large wick in here, okay, but we have to identify the top of that candle as the beginning and down to the body of the candle. Okay, and let's take this off for a moment. We don't need that. It's going to be confusing. So we have this range to consider for all this buying. Okay, as price drops down into this, we are anticipating something that would stall. Okay, price moving lower. Doesn't mean it's going to stop going lower longer term. It just means that there would be a likelihood that there would be a bounce in a bear market. Now, last week, if you followed me on Twitter, at the time of me releasing this video, I stated that we were going to be looking for bounces in a bear market. And when we say that, okay, your mind should immediately click to, okay, where are all of the buy stops? Because that's when buy stops are going to be looked to be rated. Okay, because it's a down market, it's been suppressed for a long period of time, and as the market drops, the market participants that have been bearish will be protecting their position as it drops in the form of placing buy stops right above what they would deem a significant resistance level or a short-term high. And they feel that, if it goes up to that price point, they don't want to eat into their open profits any more than that, and they limit their exposure. Well, that's exactly where the price is going to reach for. So when you're looking at price action and you anticipate levels like we're discussing here, okay, yes, the market's in a sell program. It's in a bearish trend. It is in an area of old institutional interest where there was significant buying back here. Okay, we're inside of the range here, right in here. The bearish candle. Okay, you got to use the high to the body. Okay, now there's an idea that's tossed about that it's a dynamic way of trading if you look at for instance, the body of the candle down to the wick. If price was to trade down to that price point, it would be a good buy. That's not how you use the wick to body principle. Okay, how banks would view that. Okay, what we see here is this is actually how it's being done. You find the body of the candle, in a down candle in the high. This is all thin trading in here. The bulk of the trading is done inside of the body. You use the top of the candle down to the body. This is the range that you would work within and identify. Okay, so as price would drop down at a later time into that, that's how you would use it. You do not use the bottom of the bodies of the candles and the wicks. Okay, there's a camp that teaches this idea that if you look at this, and I'll give it to you kind of like in the way it's presented in their indicator. Um, if you look at it like this, they'll say that this is dynamic support. There's nothing dynamic about that, because in reality, what you're suggesting is that in all of the wick, that's where the interest is in buying, when in fact it's not. This is inerrant price action, and many times it's raids. And a bank, when I'm in the banking level, if I want to key off a particular price level, I know that a low, okay, for instance, the body and low of this candle here, say I want to run the stops that would be obviously right below that low. They would have sell stops below this. Okay, so all I have to do is offer a buy limit to pair out with, and the market will jump down there because of my volume. It'll fill it, and it'll jump down there, fill it. But that one print in price action, making that one trade, will make all of the pending orders that reside below that level. Okay, they'll go hot, and then all of a sudden, every pending order on a limit or stop does what? Becomes market orders. To do what? What? Sell. They're going to be looking to sell it, because if they're trying to be buying down here, okay, they're going to protect their position below the low. Well, if they're going to sell their position by default, I want those positions, so I will be buying it. And that's what smart money does. They put a large pocket of uh, buy orders on limit, okay, below key lows, okay, and that's what absorbs retail and large funds that have stop orders below there. And all it takes is one order to pair up, just like that. Those orders become market orders, and once that price prints one time, it activates everyone's order, and then that's when you get these big surges. Okay, so that's how you really look at what is deemed dynamic. So the dynamic support would be, really in reality, is the high of the candle that's down prior to move up to the body of the candle. This is the dynamic support level. Okay, so you're looking inside of this range, okay, for ideas to frame a bullish scenario, not to pick the low or the bottom in this down move, but to suggest that there would be something to halt, on at least for the short term, the downward pressure. Now, could this become a low and ultimately turn around and go higher in longer term? Certainly can. But we teach, and I teach, and I maintain in my own trading, trying not to pick bottoms in the marketplace. Now, did I buy this last week and get a handsome profit on it? Absolutely. Did I hold it the entire week? Absolutely not. Okay, because it goes against the higher time frame directional sell program that is clearly depicted on your chart. But because we understand that we have price moving into this area, we don't trust every time it breaks a low in here. We don't want to anticipate continuation into that, because they may just take it lower and then have the scenario like we discussed here unfold. And that's exactly what took place last week prior to the time we're releasing this video. So now let's go and look at a time frame lower than the weekly, and that would be the daily. Okay, and let's zoom in a little bit on this one. All right, so now we have this um, level that we've highlighted on the higher time frame. Okay, and we moved into a consolidation. Okay, now prior to this move down here, okay, the range was this low and this high. All of this consolidation in here, if you look at the highs in here, we have short-term little resistance levels. Since we moved into this higher level time frame buy area, okay, where we'd anticipate buyers coming in to maybe even cover their long-term shorts from like 170, 180 to around that 172 level on cable, that would be a big area to take some profits on that long-term multiple price leg lower. When we said we're looking at bounces in the bear market, again, the idea is look for highs where stops would reside. Okay, and here's your highs right in here. See how they're relatively clean. So if you look at that, when we look at the higher time frame price charts, these are the concepts and ideas that we look for to flesh out the idea of directional premise, how to frame our trades, how to build a directional bias, or trade within a predisposed range or defined range, if you will. Now, looking at what we have here, price moved on up and cleared these levels in here. But more importantly, when it ran up higher, it didn't take out this high. We don't need it to take out this high. Look through the candle. Okay, you see this area of consolidation? We went from big ranges. What happened in here? Range contraction. What's going to take place after range contraction? Range expansion. Move lower. Prior to this move going lower, okay, we had this down move in here. Okay, now watch. Remember I was just discussing a couple minutes ago how we actually look at candles and bodies wicks? This is what you would view. Well, let me just actually use this. This is actually better. I'm going to take this box, a rectangle, and I'm going to put it at the bottom of the body of the down candle right in here. Because remember, prior to this move up, it's the down candle, okay, that creates the buyers, and they come in the marketplace and it rallies up. If it fails and goes through it, it's the wick to the base of the candle that's down. Okay, in other words, we're doing this right there. See that? Now, if you extend that, there's your dynamic resistance. Okay, you see the flip-flop that's really necessary. The camp that teaches above the candle's bodies up to the wicks is dynamic resistance. That's nonsense. Okay, the likelihood of those instances unfolding are so few and far between, you would hardly get any kind of real good setups. And you certainly aren't seeing institutional order flow like that. You're seeing the absolute extremes in those moves, and you're not going to see a lot of trading in that. Okay, the bulk of the trading is in the body of the candle. That's why we define our bearish and bullish order blocks with the body's candle and the very low, or the body of the candle and the very high, based on whether it's a bullish or bearish order block. Okay. Now, again, this will all make more sense to you when we start giving the actual trading patterns and such in volumes 9, 10, 11, 12. But for now, understand this is where we would expect price to reach up into, cutting through a candle. Again, this is not supply and demand, guys. This is where there was old buyers back here, okay, and it went up, yes, but then went lower ultimately. It stayed below this level for a long period of time, and this is the first opportunity price got back up to it for them to mitigate that position. Now they're not in a net losing position, okay? Now, this is what we blend together to define trade ideas using higher time frame price charts. If we understand that there is a bullish scenario like this, we're in an area where we didn't anticipate a buying opportunity down here on a higher time frame, and we have old lows like this, okay, because this is an old daily low. We had this noted on Twitter. I tweeted I tweeted this as a suggestion to study. Okay, here's an old low, plot that on your chart. Okay, and then let's study what unfolds going forward. We're going to look at this price action in here. Price dipped below it, yes, but watch what happens. We're going to keep this in here, but we're going to change the chart to an open, high, low, close. Okay, and we're now going to introduce a revised, well, not revised, but a revisiting of Power 3. Power of 3 is my ICT, accumulation to distribution concept, and this is really one of the things that I believe put me over the edge with what I learned from my mentor, Larry Williams. Um, Larry had this idea that, he taught very early on, back in the 70s, that the opening price is very, very important. And on big range days, very rarely does it work both sides of the opening price a whole lot before it takes off. Generally, what will happen is it'll open, move up or down a little bit. Okay, and then once it makes its low, whatever it would be, and he doesn't have anything to really define that, and that's where I came in and filled that void. Because I didn't feel comfortable with that. I was thinking to myself, here's this guy, he has all this insight, but he's admitting a, a deficit in understanding. And he had no problems admitting it, and he has obviously made lots of money without needing to know that. But what I'm about to share with you just was problematic for me. Um, his entry patterns, a lot of it requires buying on strength and selling on weakness. So what he does is in his day trading and in short-term entries is if he has an idea where he expects bullishness, okay, maybe he identified some accumulation, and we're going to talk about accumulation in a few minutes. But the opening price, his idea is that if it goes down and starts to rally up, once it goes 20%, okay, of the daily range, okay, the average daily range, if it goes 20% of the average daily range above the opening price, that's when he's going to buy. And he's going to use like a $2,500 stop on the S&P and whatever contracts that will allow him to do that. That was his money management, and then boom, there it is. Okay. Now my question is, knowing what you know already, does that sound like something you would feel comfortable doing? You're buying it after it's already moved. It doesn't make any sense. So what I did was is I used his understanding of what he taught was the open on big ranges were usually at the opposite extremes of the range and the close. In other words, what I'm saying is on up days, the close will be at or near the low of the day, and the close will be at or near the high of the day. And you can see that pretty much is what's happening here. Okay, the close is above the opening on up days, as you would expect, but the price action below the opening, that to me is what separates the elite from those individuals that don't look at price like that. Okay. And that insight is what was garnered by me when I rubbed elbows with the banking industry. And when you get the understanding of what they're doing below that opening price, everything falls into place. Now, the opening price is defined by the new day, 0 GMT, and this is the real important one for me, midnight New York time. Now, I'm not going to argue with everyone around the world that wants to say that's not the new day, okay, but I've already shown many, many times how midnight, if you look at the opening price on the midnight candle, New York time, that to me is the that's like the bones, if you will. Okay, I mean that's it. You want to be looking at that, and we're going to look at that here. We understand that we went down into an old low here, okay, and we're going to look at the idea of what takes place each day, and we're going to go down to a 15-minute time frame. Okay, we have a 15-minute chart on the British pound USD, and this is obviously what took place last week. And these levels here are that order block that we noted. It's just in a little bit different color now. It used to be that red range that was extended out in time, and this is where it moved up into. So this was where price institutionally on a higher time frame would be reaching to. So from where we were at the beginning of the week, based on this old low on the daily chart down here, was what we have here. I believe it's 146.37. Let's actually do that because that's really what the price was. So when we're down at that level, okay, we would anticipate price moving higher, simply on the idea that that would be an old area of institutional interest for buyers. Okay, and we're going to actually build in some understanding of accumulation, as you saw on my Twitter account, but probably wasn't really clear when I shared it in that video as well. I drew some lines. I'm actually going to talk about what it is that you should see for accumulation distribution. Excuse me. The idea is, okay, we have Sunday's trading here, and then Monday we opened and traded down, made a low, and optimal trade entry in here, retracement, and then rally up, closed higher on the day. Here is Tuesday. Tuesday we teach is the highest probability for making the low of the week if you're bullish, okay? Tuesday's London Open. If not, it'll be Wednesday's London Open. Well, you got two really good opportunities here because here's Tuesday and here's Wednesday, both London Open trades, okay? But now watch what happens. Assume for a moment we use what my mentor was teaching and still teaches today, and he's actually retiring in October of 2015, the time of his most recent public, announcement to the trading universe. He's actually not trading anymore in October 2015. So looking at what he suggests, he likes to buy 20% of the average daily range, um, added to the opening price, and then that's when he'll be a buyer. Well, if let's say the opening price is here, okay, and that would be, maybe we're just going to rough it, say he's buying up here. To me, that doesn't make any sense. Now, does it work? Sure. In this case, it does. But it comes right back down to, if you're holding on to it, to about the general area, maybe even a little bit lower than when he would have been buying. My question is this: why wouldn't it be more, you know, likely to, let's say we use this level right here, and again, it doesn't have to be that precise to really communicate the effectiveness of it. And here we'll use this. Okay. Now, what I'm suggesting to you is this: Power 3 says the opening and a down move away from the opening, if we're overall bullish, that's what we're looking for. We want to see this move here. That's the Judas swing. This down move is the little piece of price action in up days where you see the opening price where it opens down a little bit and then it makes that real big move up and then closes high on the day. To me, when he made this comment, and you've heard me say this a lot, he made this comment in one of his seminars, that he wished he knew just the zip code of the folks that were buying down here, and then maybe that would help. And it was kind of like a glib, you know, backhanded statement. But the long and short of it is, I said, well, yeah, I'll take that as a challenge. If he doesn't know that, I'm going to purpose my trading around learning what is going on. How do they do that? And as fate would have it, because of my own tenacity and just really drilling that charts over and over and over again. And then finally, a communication I had with a guy in the banking industry. Some of the things that he said. Now, he did not say this is what we do. Now, I just came away with it has to be what they do, because if they buy when the market's down, this is what they're doing. They're buying when the market's down prior to the move up. They buy when the market's moving against the overall intended direction of their trade. Okay, so they're buying at the most VIP pricing there is. And then when I got with studying forex, and I applied time of day, which obviously the London session creates the higher low of the day on average, 80% of the time. The other 20% is usually in the New York session. If you look at this idea of the opening price, and this is what we're depicting here roughly, and I guess if I was fair about it and zoomed in, we're going to look at this day here. This is the Wednesday of the last week, and it would be the opening price up here if you used new day, 0 GMT. If you did that, you'd have to be a buyer at this level or less. Okay, and on this day here, you'd have to be a buyer from this point here or less. Okay, so you'd have to be a buyer on a limit of this price or lower. Okay, now I'm gonna give you a little bit of a challenge. Okay, and we'll talk more about this in terms of trading um, plans and approaches. A lot of folks don't want to be up around London open because they can't in North America. They got jobs, they whatever. They can't trade. They can't intraday entry uh, for their trades around that time of day. So they're kind of like forced to do limit orders, sometimes missing trades or getting blown out, or only trading in New York or Asia. Of all times, really, you shouldn't be trading Asia unless you're doing yen or Aussie pairs. But if you trade with a higher time frame premise in mind, okay, you can have 100 pip stop trading plan and use this idea that at the opening price, okay, you want to be a buyer. And let's just say, for instance, you want to be a buyer 20 pips below the opening price when it's overall bullish. Okay. And from that point on, you would have a stop loss 100 pips below that entry point. So in essence, it would be 120 pips away from the opening price. What's the opening price? Well, you would know what that opening price is at 0 GMT. Now, 100 pips stop, okay, in this instance, 100 pips risked. If you did that, let's just, and this is just one example. It's not, don't build the idea that's always like this, but let's say, for instance, that you know, you were buying it here. Actually, let me just use this. Say you were buying it around here. That right there is 100. That right there is your 1-to-1. So you would have a risk of 100 pips. Once it moved to there, you would have 1-to-1. There is 2-to-1. 3-to-1 is right there. And once we got up into this area here, it's 400 pips there. So there's your 4-to-1 trade based on a higher time frame premise, understanding institutional order flow, the idea of expecting some buying down in here, old daily low, buying below the opening price using a 100 pip stop, not needing to be a day trader, not needing to be awake during London session, not needing to be so precise that you want to be ICT clone. Okay, you don't need all that stuff, and that's why many times I don't want to give you my trades specifically, because it builds this unrealistic expectation that you have to be just like me, and you're never going to trade like me. Many of you, realize it or not, you're going to actually become better traders than I am. And it probably sounds like a farce me saying that, but I'm telling you, it's going to happen. And I believe, and I'm going to say this, and I'm probably going to get all kinds of backlash, but I believe I am a way better trader than Larry Williams. I love him as my mentor, but I have grown and evolved beyond a level that he admits in his own trading. In his own trading, if you look on the internet, Google it, you can see some of his screenshots that where he's entering. He's doing exactly what I just told you. He's buying well above the opening price. When I teach that you're buying below the opening price, when you're expecting bullish prices, it doesn't take long to look at a daily chart, put it open a high low close, and you'll see there's a small little movement below the opening price. That little movement is small in comparison to the overall expansion of that daily range. And here's the thing, what we discussed here, okay, if you were holding on to that and didn't do any scaling, there's a 4-to-1 setup right there. Let me ask you a question. If you were trading with this approach, okay, and you had this idea to do this like on a weekly basis, okay, and you were able to do it with multiple pairs, okay, you can do it like with a portfolio perspective. You can trade 1% risk, so you would have 4-to-1. You could risk 1%, you'd make 4% there. What if you did that every week? That's 16% compounded every month. It doesn't take long to grow a lot of money making 16%. And you're not a day trader. You're not trying to be in there and split hairs on every little minute detail, and not even worrying about market maker profiles. You see what I'm saying? I'm giving you all kinds of tools and concepts, but you don't have to use every single one of them. You just got to find what it is that you're trying to do. Well, how's it fit for you and your trading? Because not all of us can be day traders. Not all of us can be short-term traders. Some of us can't be position traders. It's just a matter of taking the tools and understanding it and blending it in such a way where it makes it useful to you and you can profit with it. You don't have to use every single tool, but understanding the power three with this concept leading to higher level time frame areas of institutional interest, this is where we would be aiming. And as luck would have it, I don't believe so, Friday is where we would see the range completion, Thursday or Friday, and it makes it here. Boom. Now, let's take a closer look and apply time and price theory. Again, we have consolidation here. Market comes down and rallies up. Rallies away from a little consolidation right in here. We taught in Market Maker 6 and 7 the buy profile and sell profile. Market Maker, both instances. Okay? And my question to you is this. If we understand price, actually let's go back out to a 15-minute chart. If we are looking at price here, okay, consolidating, and it rallies up, when did we talk about looking for market maker sell profiles? When it moves up into a higher time frame resistance, right? Would this area that we identified earlier, would that not be an example of that? Sure it would. Absolutely. And you probably already see it, but here's the consolidation, okay, or during the initial accumulation, the initial runaway, okay, and then reaccumulation, moving up into smart money reversal, the low risk short, the break in market structure here, the redistribution back down into the initial area of accumulation. Now, it did not break it here, but we don't always see that. It rallied again, moved back up into what? This old area of redistribution. And here's the thing, look at this down candle. Institutional pricing, using institutional order flow, down candle prior to the move up. They were the buyers here, right? See that? Right here. Now watch if we extend it. Market moves right up into it. Sell it. They were buyers here. We're on the distribution side of the cycle. So you want to sell it here. And if we go out to a 30-minute chart just for clarity and visibility sake, and we'll take out the day dividers. Okay, you can see the consolidation here, accumulation of shorts, breakdown, redistribution, run to support, smart money reversal, low risk buy, reaccumulation, moved on up into clearing out the original accumulation point here, and we're to distribute those positions as well. Okay, so when we're looking at higher time frame charts, we're looking for areas of interest on the institutional level. We're looking for areas of liquidity, but we're more importantly, when we identify these higher time frame price points, like we have here, this old low on the daily chart, 146.37, and an area where institutional interest would be residing, what we have defined is this. We defined a range at which price should expand in, and it gives you what? A directional premise. And you maintain that directional premise, okay, until it clearly breaks down and indicates that it's not going to happen, okay, and you stick with it. So even though we were buying in a down market, we understand how we look for stops, higher level interest reaction points where we can anticipate institutional order flow to come in the marketplace, as we see here, okay, and we wait for that to unfold each day using power 3, not even necessary to be in there day trading, okay, but having the mindset of utilizing higher, wider stop and still being able to be a participant in these types of trades. Okay, so now let's look at what that did. Okay, this is one of the tweets I sent out last week prior to me releasing this particular installment of the series. I asked everyone, what do you see here? And it was prior to this move up we were just disclosing. But I mentioned again at the time, I said that supply and demand, which is a concept that's, it's pretty popular these days, but again, it's not giving you everything, and it does not give you institutional order flow. It does not give you institutional perspective. It just gives you part of it, okay? And they teach not to cut through candles. It's a fallacy. Here's that daily low, 146.37. Okay, market dip below it again, dip below it again. But looking at in here, okay, what do you see? The question I'm asking is, what do you see going into, let me take this off here so we can see without being disturbed with the chart being jerked back and forth. All right, prior to this move up, okay, there was some institutional interest here for being a buyer. Okay, they bought in here, obviously, and then ultimately went lower. It broke down in here, okay? When the price broke down, okay, when it was going down into this daily low and entering into that higher time frame area where we were expecting some buying pressure to halt lower prices, and that's all below these levels in here, okay, we were in what we deemed a potential market maker buy profile. So when we see these buying points in the past, even though they have candles that you would have to cut through, in this case here, okay? When we go down to the buying point, when there's a smart money reversal point, like we talked about in Market Maker 6 and Market Maker 7, respective to the buy and sell profiles, when the price starts to go on the opposite end and start moving higher, as we have here in the Market Maker buy program, I'm sorry, Market Maker buy profile, on the other side of the curve here, okay, once we had the reversal point, every time price comes down to an old level of buying, it should be supported. So if we see that on the left side, okay, obviously there was a buying pressure here, okay, and it gave up the ghost, yes, but that's fine. We know at a later time on the other side of the reversal point, those buyers, because think about what I was talking about all this time, over the years and years I've been teaching. Smart money traders buy early. They have to. They have to work in their positions. They're hedging in as it's dropping. This is a hedging point where they bought some, dropped down lower. That position they bought here is underwater. Yes. The position they're holding here is underwater. Yes. But look what happens over here. They get into that same area, they reclaim or responsor or and recapitalize the buying that was taken here. They add more money to it here because now they've done the turn here. They bought it here again near the low. They bought it again here. Price rallies up through a level of resistance. Okay. What's it do? Drops back down. Why is it reacting here? Over here, there was buying pressure. The longs that they assumed here that were underwater all this time is now going to be reclaimed. They're going to responsor this bullish order block, and they're going to build positions in on that as well. And it rallies on up and comes back down into what? Another area of this consolidation. And let me zoom in because it's kind of difficult to see in there. But this down candle prior to this move up, okay, that's another bullish order block. And what are they doing? They're reclaiming it and capitalizing that buying opportunity right here for what? The continuation higher and into that area that we discussed just a few moments ago here. This is where they distribute it. Okay, can it go higher? Certainly, but this is what we do. We measure the buying pressure, okay, and interest based on what the buying pressure had done in the past. They're clearly noted, their fingerprints, their footprints, okay? And yes, you're cutting through candles to see them. You're cutting through candles to see them. Supply and demand is a load of baloney in regards to not cutting through candles. You're never going to see it like the banks are operating. Okay, you're not getting this from a ticket runner perspective. I'm sorry, I don't mean to be rude or arrogant, but I'm telling you, when you're working with the bank traders and you're seeing what they're doing on a daily basis, this is what they do, and this is how they recapitalize old buy points. Okay, and that's it. This is how it's done. Okay, um, if you were looking at just this, okay, and say for instance you were looking at the idea that classical support resistance, okay, this is why it frustrates folks that trade support resistance. Clearly the high here, clearly the low here. So if price comes back down to that price point, they're going to be a buyer. Well, that would work. It would work. If it went down and you would have been buyer and it unfolded as it did, it would have worked. But they don't want every Tom, Dick, and Harry on this move. They don't need it because the real price points are over here based on what we just described. Okay, so we have a market maker buy profile, and all the price points that I taught in 6 and 7 of this series, all of those are respective on the other side of the curve. Okay, so as you distribute down here, the little blips and buys, okay, they're going to be reclaimed and responsored on the other side of the turning point. And that's how you identify and map out where those price points are. See, it's not that I'm looking at the chart and saying, okay, well, here's where I'm going to draw a box here, and I'm going to draw a box here because it happened in hindsight. No. What I want you to see in this example is every time you see a market maker profile, buy or sell, look at the price points where the bullish order blocks take place as it's dropping down in a buy program, or the buy profile rather. They're going to be reutilized on the other side as they reaccumulate. And that's the key that you don't get just looking at price and support and resistance or supply and demand. Okay, no other concept out there teaches this stuff. And yes, I'm being flamboyant about it. because I'm adamant. I'm telling you that when I got this in my head and I knew what it is I'm looking for, it took away all of the ambiguity about looking at price action and what should I be looking for. Well, now you know exactly what you're looking for. It never changes. It's always the case, and you're just using a higher time frame premise to flesh out that idea. Now, now again, it's not that you're going in there hunting patterns because you're a pattern trader. Patterns are going to form from the higher time frame levels and ideas that we just described in this video. Having higher time frame liquidity pools defined by ranges, as we discussed, and looking for higher level institutional interest where they had done previous trading in the past, where they've left fingerprints or footprints, if you will, major reaction price points. Okay, when price gets to those levels, that's what you're trading in between. Okay, so if we're in between a major mile marker like that, okay, like a daily low and an area of, um, well, let's go back up to this area here where we talked about. This is that daily low, and between these two price points, this old order block and this daily low, look at all of the opportunity being buyers in here. Even if you're a day trader or a scalper, just focusing on being a buyer with the premise that understanding and keeping in mind that you are still buying inside of a downtrend. Okay, you don't go in and start laying out all your triangles and harmonic patterns saying I'm going to look for bats and bullish butterflies and Gartley patterns and all that stuff just because a Gartley pattern appears in your chart. You have to have a context to frame that idea on, and then your patterns, whether it be harmonic or just simple retracements or even classic price patterns. For instance, we have a bull flag here. Okay, big bull flag right there. Okay, if you understand that, if we take that and just use that idea, I'm going to use the flagpole here idea, okay, and project that from here, you get pretty good symmetry. See that? And you have another bull flag here, up and down. Take that over here and measure it here, extend it from the low. Okay, nice little opportunity to take some profits there. Again, classic bull flag right in here. Measure it. Here's the flagpole, classic flag pattern from the low of the flag, project it up, right up in here. Doesn't get to very high, no. Do you need it? No. Okay. You can draw the flagpole from here to here, project it from here to here, and it would fall just a little bit short. But nonetheless, you're getting classic price patterns still giving you ideas to keep you on the right side of the marketplace because you're working within institutional order flow. See the difference? I'm not framing this on moving averages. I'm not framing this on overbought and oversold RSIs and Williams percent Rs and stochastics. I'm not doing any of that. Okay. But now watch. If you have this idea that you have a range that you're going to trade inside of, and you're going to look for these objectives to be met because the institutions are going to want to be able to get out up here based on what we described earlier. Watch what happens when you do add indicators. Now, again, don't fault me for this. I'm just trying to show you when you do add the indicators how powerful it is when you use it in the proper context. And let me drill in a little bit here. All right, now we have, let's do our classic 2080 overbought oversold in our stochastic. Okay, I'm just going to rough it. It doesn't have to be perfect. Okay, if we're oversold, below the line here, okay, you'd be a buyer when it crosses over. Right here, be a buyer. Boom. Right here underneath this this low, it really doesn't get below it. It does on this level here, but I like when both lines go below if you're going to be an indicator trader. Here goes below it and both lines cross over. You want to be a buyer, gets the low. Here's a good one crossing below, and you had to sit through a little bit of consolidation and it takes off. We went below it again here, crossed over, and a little bit of a bounce. Okay, but if you look at divergence, if you're a divergence trader, you have a nice divergence with the lower low here, and then the stochastics diverges bullishly and below what would be deemed as oversold, crossover, and there's your entry point. Okay, um, that is how you use indicators. If you're going to use indicators, that's when they're going to work. Okay, but if you just look at every single time, they're oversold. Just because you see it oversold doesn't mean anything. Okay, it doesn't mean anything at all. Okay, but when you have an understanding of institutional order flow, you'll know based on the concepts we've shared in this video, and you start applying price patterns. And one I like is the Stinger. Okay, and um, another one is ICT Holy Grail, and I'll talk about them. You've probably already seen a video where I use that, but it's blending patterns within another pattern, and I'll just show you one here. We have a low in the stochastics here, and we have a lower low than this one here, but the price is high. And also, look, we got a divergence bullish. So what we have here is a type 1 bullish divergence within a type 2 trend following. So you have a low with a higher low here. Price is moving higher. We have a bullish divergence, what everyone understands is classical bullish divergence. Then we have the stochastic is lower. Okay, so this is trend following in nature. So when you see that, this is going to be a really strong buy. And you can see it had really no retracements from that price point at all. It just kept on going up into the area where we'd anticipate. Now, again, that's just to illustrate the proper use of mathematically derived hindsight indicators. Okay, they're useless to you. And really, what we described already, okay, this is useless to you. You don't need it. You have no need for it if you understand what was already described in the video. But I tossed that on there just to show you that yes, indicators are useful when you use them properly, but you don't need them. You do not need them. If you understand price action, you absolutely have no need for them. But now, when we have the idea of looking at price with an idea of accumulation underway, we have a low here in the euro. And actually, let's go out to a weekly just to build some understanding of why this would be even suggested. Okay, we have a nice low here. Okay, and price reacted. Okay, prior to it, we have a low here, and then here, all this price action. This is an area to anticipate institutional interest in the fiber. Okay, going back to a daily, and we're gonna zoom in. Okay, we have the down candle prior to the move up. So we could have anything below here is a buying opportunity and still be above this low. Okay, and at the same time, we had the British pound, and I'm gonna have to take all this stuff off to get it, but that's fine. We've already talked about everything we need to be talked about as it relates to that pair. Okay, and I'm going to draw that daily low back on so you can see where I got it from. We have this low right here. Boom, 146.37 right in here. Okay, and we had a lower low here on cable. You see that? Fiber was not. Okay, so somebody on a large scale was coming in and accumulating in the market. At the same time, the dollar, let's go out to a daily. Same time, the dollar was unwilling to make a higher high. Now, it does not mean we made a high and top in the market on the dollar. I'm not suggesting that, okay? But for the near term, it gives you an indication that we could expect at least a bullish bounce in the fiber and cable. But look what's happening. Cable went lower, yes, okay? But now, let's drill in on this recent low. Let's go down into a hourly chart. And I'm going to show you how you can actually see accumulation as it happens. Okay, and then we're going to go down to a daily on the fiber, moved into an hourly chart. Okay, It's nice because I already got that line here. As we made the lower low here, okay, and then we bounced. We came down, made another low. It did not go lower than that low. The prior low is here. Okay, I'm not noting a head and shoulders inverted pattern. That's not what I'm doing here. What I'm showing you is accumulation. The market makes a low, bounces at a level of support where we would anticipate support, retraces back into a down candle bullish order block. Okay, we're right inside this bullish order block right here. The low here is made lower here. So we were able to go lower than we were here. Now watch what happens. It doesn't always work, but when people ask me, how do I know which one of the pairs I'm buying when I'm looking for SMT diversions? And if you don't know what that is, you didn't watch my other videos, and I'm not teaching it here. Haha. the If you're looking for which pair to buy when you're bullish on correlated pairs, the reason why I buy certain ones is what I'm showing you right here, and you'll see that it works more times than it doesn't, but you'll see in a second. The high is 315 pips from the low here. Now, are you going to get every single one of those pips? No, but the range is 315 pips from the low here. Okay, now watch what's happening from this low through the low, this point, and then the retracement. Okay, the low is lower here. Okay, so it's down, even though it does react. It's from this low to the low here on both ends, because what we're doing is we're measuring market structure relative strength. What? Not RSI, the indicator. I'm showing you how to measure market structure's relative strength. You're not going to find that in any books, are you now? Watch. Let's go back out to the cable. Same thing happening here. We made the lower low than we did here. But look closely. This low didn't go lower on the heels or the right side of the low like we see in the fiber right here. What does it do? It makes a higher low. What do you think that's indicating? This is suggesting that on an institutional level, there's a more aggressive buying program going on in the cable versus the fiber. Well, let's test it. If we take our little trend line from the low here, draw it up, drop it, and then pick it up again, and you'll see the line. See, it says 139 to the right of my cursor. And now we're up to 200, 315, 400, up to the high of 448 pips. Okay, you see that? 448. The fiber moved what? Did it move 448? No, 315 pips. So which was the outperformer? Cable, clearly. Now, this technique I morphed into by a concept that Larry Williams taught, and you'll learn it when we talk about his um, concepts when I blend in with my swing trading, and we'll talk about it also when we talk about stocks and commodities, where we can find the strongest out of all the industry groups and sectors and commodities, which will be cool for a lot of you guys that like to trade futures and stocks. But nonetheless, what it does is it helps ferret out the outperformers and the laggards. Now, why does it work? If we understand that we are in an area of anticipated retracement, or maybe even a long-term high, or if this is in a bear market and this was a retracement up to a level where we anticipate some selling, um, if we see the scenario like this where we don't see a higher high in the dollar, well, that should be seen with a fail to make a lower low like we see here in a fiber. But look what happened in cable. Boom. See that? Huge disparity. Huge disparity. There is a crack in the correlation, even though we didn't make the lower low in either one of the pairs, respectively. The fact that we didn't see the lower low in cable here that we saw in fiber is a huge indication that there was a lot of buyers in the British pound and sellers of the dollar. Even though that the fiber moved up in sympathy, and yes, it would have been a profitable trade to hold that, the laggard is the fiber and the leader is cable. Looking at the hourly chart on the dollar, so we can give a indication of how it looked on both the dollar and its counterparts, fiber and cable. You can see that we had a failure to make a higher high. That's fine. And we saw that here as well. That's respected. And that's respected. But now look inside price action, inside it. Looking at market structure, and no, you don't learn this on any other website or YouTube channel. This is how you deem accumulation. Even though it's only expected to see a retracement, and we didn't ultimately call a high in the dollar because it still could go higher. The scenario that we see here is the buy profile, market maker buy profile or model here, and you see the market maker buy model here. You see the market maker sell model here in the dollar. See that? Pretty neat, isn't it? So when we look at price, we're not looking for patterns. We're looking for institutional order flow in institutional areas of previous interest of buying and selling, looking for the reaction points. We're looking for range contraction to anticipate range expansion. Okay, and we look for those to blend. There's a confluence of all those factors that come together. When you do these types of things, and then you add, for instance, the calendar, you guys should be looking at that every day, okay, at least once a week before the week begins, and make a notation on what high impact release is going to come out, what market driver is going to come out, what time of day that's going to happen for particular currencies that you trade. And you can anticipate the volatility injections that are created by those market releases to fuel you a move into these areas as we've described in this video. And then your trade will form on that framework. So there's a combination of all these ingredients that come together. And yes, we're getting closer and closer and closer to what will be described as specifics of step by step by step in 9, 10, 11, and 12 volume. But right now, you just got another insight that took you light years ahead of the retail universe, and as it relates to price action and how to look at accumulation, how to look for reclaimed and responsored order blocks, and how we use them in blending with market maker profiles, sell and buy, and how we look for higher level time frame charts to help us aid in directional premise and work within counter trend biases like we just disclosed in cable. So with that, guys, I wish you good luck and good trading.